Hello, everyone. Welcome back to the Rational Investor.co's. Where are we here? This is our school for trader development. Yay! Welcome back to class, guys. I see Christian's already got my. Yeah, looks like we're live on YouTube. That's good to see. See, Christian's already got my tagline down here and all ready to go, ready for Brian's big injection of PMA to get his Wednesday going. Welcome back to class, everybody. We'll be spending the next couple hours chatting and reviewing what we needed to cover this past week. I hope you guys aren't feeling too overwhelmed with the course material. We do throw a heck of a lot of learning material at you in a very short period of time. Probably, if Monday people, if I didn't mention it to them, but, I'll just keep reiterating this over and over and over. What really should happen here is, this sort of eating our vegetables part of the course. This is going to be part of your trading for the rest of your life, right? Understanding the strategic, the big picture, the lava flow of capital around the world, right? This stuff, it's not going to change. Understanding, what the predominant demographic is and why government policy is the way it is based on those demographic flows. That's not going to change a heck of a lot. I think also too, us just having a basic understanding of fundamental analysis. Great to see, I actually have created a student files section on my browser here just to have all of the different spreadsheets and stuff that you guys have put together here through the course. And you guys have just done some fantastic work. Just a few of the spreadsheets that people have shared. And there's your spreadsheet, Christian. So I am watching, and it's great to see you guys doing this hard work. You're just basically demonstrating that you're paying attention, you're in tune, and you're trying. And keep in mind, this is going to be an evolutionary process. If you had the opportunity, for those that are crypto oriented, if you had the opportunity to listen to the CFTC meeting earlier today, what I see is that even quote unquote industry experts are saying that this space is still filling out and that we're still, searching for standardization and best practices and all that kind of stuff. So, this is an evolutionary process and it will keep evolving over time. Hopefully, we've given you a nice simple framework. How do you value commodities? Is there some sort of benchmark that we use to value commodities? Cost of production, right? So, those kind of things should be fairly straightforward. I was just even curious. I went on a crypto site the other day and I pulled down their various different types of proof of, staking, proof of work, proof of stake, all these. And man, there's some just wild ones that are being developed right now. So, and those people who are interested in stock investing, those stock screening models that were taught to me over the past 30 years, they are extremely powerful models, and really they're not going to change over time. CanSlim is just as valid today as it was 25 years ago when Mr. O'Neill built it. VCIM was taught to me by an old VSE floor broker. And good fundamental value is good fundamental value, right? The dovetail to that conversation, of course, is this week. Really, what we really wanted to do was we wanted to educate you on what the heck rational investing is. This idea of trying to screen your universe for half decent fundamental ideas and sort of maybe put the shit coins or whatever you want to call them, shit stocks that have no earnings and are total scams, no reporting. Remember, like Bulletin Board down in the States, they even put right on their prospectuses, the directors of these companies have no legal obligation to tell you the truth. So, we wanted to equip you, the fundamental analysis part of the course with that first half of this idea of rational investing. So once we've created sort of a list, a vetted list of ideas that we can consider, then we're going to go to the technical analysis school to try and help us time our purchases a little bit better. And ultimately, coming out of the back end of this course, you should be able to not only discern sort of what is a half decent fundamental idea versus not, and then once you have your half decent fundamental ideas, okay, now when is a good time to actually consider pulling the trigger and actually investing your hard-earned money? It's true, but is that the truth? That they don't have to tell you the truth? I don't know, Gerald. I suppose we could go down a black hole of spiral there. Is it the truth that they don't have to tell you the truth? That's the truth, or blah 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 blah. All right. So this week, really, as I said before, this was going to be our very basic introduction to the world of technical analysis. Because we do deal in charts so much, and a lot of the nuances and the tools that we're going to use down the road actually require their expectation is that you understand the basics of how technical analysis works before you can even consider starting to use these tools. I think it behooves all of us that we took a week and we just sort of gave you a formal introduction to this world of technical analysis. What are some of its drawbacks? What are limitations? Little bit of history. I think it's important that we all understand the various different schools of technical analysis and how, just like in the fundamental analysis world, some of the schools don't even like other schools in technical analysis, and a lot of ego gets involved in this space. And if anything, I don't really want to say this is the right way, that's the wrong way. What I'd rather you do is I'm going to set the table for you, going to give you a nice broad overview, introduction to all of these different tools. And ultimately, just as sort of we finished with this module, what has to happen here is I'm just going to keep throwing ideas and concept at you. At some point, you're going to be like, whoa, that one really speaks to me. Oh, I really like using that tool. Oh, I really like this tool. And in essence, what should happen is we should just pick and choose from all the different tools that Brian's going to introduce you to create our very own personal setups. You could argue that the second half of this level 1 course, the visit to the candy store, is all about that process of building setups and giving you all those different tools to vet out setups, location, indicator confirmation, structure. But to actually get to that point, we've got to cover a whole bunch of basics first, and that's what this course module is all about. I didn't need for anybody to come away from this course module saying, all right, I got my setups, I'm all ready to go rock and roll. This was supposed to be nothing more than we were going to introduce you to this world of technical analysis, make sure that you understand the very specific definitions and concepts, and then give you the ability to now start hunting things like structure and to start seeing structure within indicators. And in my opinion, this is the real value of indicators, this idea that they can often tell you a little bit about the future, rather than classic, most people that don't like indicators, the reason why they don't like them is because they believe it tells them about the past. It's lagging information. And what I really wanted to convey to you through this week was the idea that we can use indicators to actually tell us about the future. And, for those that are just watching this Wednesday class, you probably saw the Mondayers we just basically gave them an assignment at the end of the day. You really want to get good at this, you have to practice. And so a lot of them, they had a simple assignment. They had to find 10 examples of divergence. And the long and short of it is the first few that you do, they're going to be messy. They're probably not going to be right. They're going to be whatever, all over the place. But as you practice and you get guidance and you get through that uncomfortability sort of feeling of doing things the first few times, then you're going to get the hang of this. And it will come, but it takes practice. All right, so that's sort of the overview of what we were going to do here this week. We wanted to make sure that you had just a nice basic introduction. We wanted to introduce you to the 3 different primary schools of technical analysis, that being price analysis, and we wanted to get in to talk to you and introduce you to this idea of market state. We also wanted to make sure that you are equipped with the primary trend reversal, what we call market structure patterns, and you have no choice. You must know these as technicians. And if you don't, I think in the video, my recommendation was print these sheets out, staple them to your forehead, and get knowing them. You must know this. There really isn't any ifs, ands, or buts about it. We wanted to then introduce you. We Wednesday guys can post our 10 div attempts for feedback. Absolutely, Miguel. That's the whole point of this course. And we've got James in the hangout with me here, and he's been on the site just posting stuff as we go, the Q&A document and stuff. We also have Garrett as another TA. He's on the site. Myself, Julian pops into your class every once in a while. Anyway, and of course, the great part about this, guys, is that the people, I want to work with nice people. And it's interesting. There's actually some people that are maybe a little bit not nice. And in the past, I've actually, just politely asked them, we don't really need you in this community. I only want to really work with nice people. So as a result, our members lounge, super, super nice people. These people have all been in your shoes. My advice to you guys is get into that members lounge and interact with this audience. These are really, really nice people, and they will help you. So not only is there myself, there's James and Garrett, there's, TRI management like Julian and Sjord, and then we have this awesome community of members in the member lounge, and all of them would be more than happy to try and help you. So yeah, and the more interaction you do, the more posts you do, the more, guys, am I getting this right? The better off you're going to be. It's just as simple as that, people. Seriously. So we wanted to, as I said, talk a little bit about price analysis, talk a little bit about indicator analysis, this idea of indicators really primarily give us 2 messages. And I really wanted you to understand this idea of divergence and how we can use indicators to tell us a little bit about the future. We finished off this introduction with the 3rd school of technical analysis, which was, it's often overlooked, and especially in the public, they're not even really aware of this school of technical analysis called intermarket analysis. And there's a lot of people that do a lot of work within the industry that is just purely intermarket analysis. Things like yield curve, right? Dow theory, breadth of the market. All of these things are all examples of intermarket analysis relationships that are a very unique and very real part of the technical analysis world. And then finally, we wanted to just simply introduce you to this idea that everything that you do here is all about what works for you. If there's an idea or a concept that I've imparted onto you and you really like it, then run with the ball. If, however, something just doesn't fit with you and it's not comfortable, don't force it. I think it's a good idea to practice, don't get me wrong. And of course, divergence is a hugely important concept. So to a certain degree, we are going to run into this. And in the candy store, we're going to keep running into this divergence concept. By the end of this program, you're going to be seeing divergences in your sleep. I can pretty much guarantee that. Go slowly. We're not in any hurry here. Try and just get the basic concepts, the basic definitions down, and see if you can find examples. I was really, really impressed this morning, and I think the gentleman's name was Keith. And he put a chart in this lounge here that was just exactly what I'd like to see from you guys. This part, sort of at this point in your education. This is just beautiful. So, and I think his name was Keith. Oh, we got to give him, yeah, Keith Sullivan. Way to go, Keith Sullivan. So impressed. So he's taking the tools and he's trying to identify things like market structure, big head and shoulders. He also took the time and threw on an RSI study here, and he noticed that the price was making higher highs, but the RSI study was not. Way to go, Keith. He, a little bit side, but, on the break of the head and shoulders, he noticed that price went into quite a downtrend. And then he started to see that RSI was starting to make higher lows, but price was still making lower lows, which is divergence. He also noticed W's on his price chart. We had a big bump up in the price of the asset, but he also noticed that here the RSI was not making higher highs and basically noted it. I was so impressed when I saw this image. It's just exactly what you need to be working on right now. You notice that there really isn't any trade notification. He's just simply going and trying to identify structure and identify divergences on a price chart. This was just great work, Keith. Hats off to you. I was very, very impressed. In fact, I even said, very, very nice work, Keith. I got 2 veries there. Way to go, Keith. So that's really what I want us to be thinking about right now, right? We don't necessarily need to be setting up trades. What I really want you to be able to see is, can I find examples of structure? Can I find examples of divergence? And what happened after? Okay, so I think what we, really our primary objective for this automated program, and I did have, somebody on the Monday class said, do you think you could just take 5-10 minutes and just review what it was we were supposed to be doing this past week? So I thought that was a nice little spiel I did there for you. We'll spend basically the rest of our time here. We got about an hour, 40 minutes or so, just reviewing your questions, the back end of the Q&A document. You can see what we did on Monday. And, whoever helps me out with typing up these documents, just hats off. Great job, you guys. Just fantastic work. So if anything, maybe what we should probably do is have the Wednesday session linked in here. So whoever's got that handy, I think we have it just up here, don't we? I think this is it. Can we do this? I think this will work. Let's see what happens. Boom. There we go. Yay. All right. So that's there for you. If this was just one person individually, hats off. I mean, way to go. Brilliant work. I think it's a good idea that, all of you students sort of work away on this. It's just great. And, you can watch the Monday video again at your leisure. You can now watch the Wednesday session here. You can go through all the Q&A. And frankly speaking, this is a lot of material for you guys. You should really have a pretty good understanding with the lectures, with this Q&A document, with the Monday and Wednesday sessions. I think you really should. You guys should be set up really well here. If after all of this, we still don't have your questions answered, then, please, reach out to, like I said, Garrett, James, myself, and even the TRI staffers can help. So, okay, so let's jump right into these questions. And once we're done the questions, then we'll go through and we'll just walk you through the course quiz just to make sure that you have all the correct answers. And that should be, a good hour and a half here, get you guys on your way. So Question 18, where we left off, I did not fully understand how to interpret the US dollar index. Can you elaborate a bit? Example, if I sell an American stock noted in US dollars, will it then affect the index? Or is it only affected when going into US dollars from a foreign currency? In other words, which asset classes does the US dollar index account for? So the US dollar index itself is technically a basket of world currencies. This was created after Mr. Nixon took the Americans off the gold standard and created this thing called the fiat currency system that we live in today. So theoretically, and you can always just Google this, what is the components of the US dollar index? Right now, I think it's about like 35% euros, about 10% British pounds, 5% Canadian dollar, 5% Australian dollar, about 15% Japanese yen, and sprinkling in some like Kiwi in there, I think too. But in essence, it's supposed to be a proxy for the sort of G7 nations when they were fighting the Cold War. The primary drivers really are the euro and the Japanese yen, and then all the sort of tertiary currencies are all on the side. If you, and keep in mind that these kind of indexes and capital flows, they're dominated by like millions and billions of dollars. You know, the Forex market on a daily basis trades $4 trillion. So, is any one of our activities in the market actually going to affect this US dollar index? Not likely. And really what this really is you remember from our strategic planning part of the course, the US dollar index is, remember, it's this shell game that we play where none of these fiat currencies really are of any great value. But it's just a question of which central banker is going to pay you the highest rate to own their particular currency. So in this particular case, right, ironically enough, if you have the US dollar index itself trending higher, then that means that people are actually pulling their money out of Japanese yen, pulling their money out of euro, Australian dollar, Canadian dollar, British pound, and they're socking it away into the US dollar. And usually what they do in that case is they just buy treasuries. And keep in mind, right, most of this, right, is like fixed income market. Who's buying their T-bills to collect the highest rate. So, if you understand that these currencies technically do not have any value, it's just really a question of who's going to pay you the highest short-term interest rate to hold their paper. And we have to understand that you and I, we don't really affect this. It's going to be like multinational corporations that are moving, like hundreds of millions, if not billions of dollars around the world. And then, of course, there's the anticipation of what they're going to do. So, if the Federal Reserve in the States is perceived to be raising interest rates, and the rest of the world are lowering their interest rates, well, obviously you're going to see a lot of capital flowing out of those world currencies into the US dollar index to go and capture that yield. I hope that helps explain it. That's it. This is like a you could easily take a whole university course on trying to explain the inner workings of the US dollar index. There you go. So Miguel's already found it. Wow, is the euro already? Is that high? 57%. Jeez, I didn't think it was that high. That's interesting. I didn't think the euro was that high. Trump University. Oh, geez, don't scare me there, Alex. I'm not even going to comment on that place. So actually, that's kind of cool. We should probably even just take this breakdown sheet. All right, thank you. I'm surprised the euro is that high, but I do like the fact that you went and found that data for us. So thank you. But I'd even just say, there's a nice little reference for you. of how the US dollar index is constructed. Miguel says, how does it change the composition? They can tweak it to serve their purposes. Yeah, technically they can. They, them, those guys. And I think that like when the euro currency, keep in mind, before the euro currency, right, you had French franc, you had German mark, or, I think it was called the D mark after the end of the Second World War. All the currencies, all the countries that are in the Eurozone right now, they were all in this index. So, and of course, everybody who's outside the U.S. thinks that whatever the U.S. does, it's all a big conspiracy to fuck over the rest of the world. I wouldn't necessarily say it's conspiracy. It's just whatever works. And they sort of come to a consensus. All right. I think I'm probably just going to leave that question at that for the time being. The simple, what you need to take away from this course is really just the US dollar index is a fear proxy. So if everybody's piling into the US dollar and out of these currencies, it means that world growth is coming into question. That's really what I want you to be taken away from this. I suppose one could argue, demographically, through the 1990s, we had a strong U.S. dollar. We have baby boomers, a growing economy, but we also have to understand that that was in a world where the end of the Cold War. So we had a lot of, obviously, the Americans being the leader of the West, and they won the Cold War. A lot of capital flowed into the U.S. dollar because of that. But on balance in the marketplace, if the U.S. dollar index is rallying really hard, it's actually deflationary. Gold price, for example, will collapse because it's priced in U.S. dollars. So if the U.S. dollar index is going up, then the gold price has to go down just to stay equal. All right, let's keep moving on. It's a good question, though, no doubt about it. But I don't think it's actually even that relevant to your particular trading here in the short term. This is more like a philosophical question. All right, is there an index that gives a hint on how many money? There is parked on the sidelines. Not that I'm really aware of. I mean, I suppose you could go and do things like study M2 money supply. That would be sort of like under macro fundamental analysis, so not even relevant to our conversation here today. I don't understand the phrase volume speaks volumes. What does that mean? Okay, so whoever asked this question, do you remember what is our shopping mall analogy? What is the number one driver that the technician is watching for? Watching for something. Not that I now of you, maybe try studying macro. Wow. Not that I know. Oh, I see. Know of. Know of. Yeah, maybe go know of, comma. Wow, now we went to a different color. That was weird. Maybe let's go macro FA M2 money supply. So you want to do a little bit more research into that. Google M2 money supply. Okay, I don't understand the phrase volume speaks volume. So did we answer that? Good, we did. Excellent. So hopefully that analogy unto itself is exactly the answer to this question. Simple as that. Okay, and a deeper dive into volume analysis. Could you explain how we analyze volume in relation to times? Okay, so this question here, and James already had answered this, we're going to spend a whole week studying volume, so no need to even address that right now. All right, can you explain the fundamental behavior behind why a W or M structure steps up either up or down move? We did this on Monday, and I pulled out a chart on the Monday video, and I explained what M's and W's are. In essence, they are the validation of a new uptrend. So it's critical that the right-hand side of the W is higher than the left-hand side. And so quite literally, this is where demand overwhelms supply here. This is where demand overwhelms supply here, a higher level, implying that more demand is coming into the market. And the exact opposite works with an M. So please go and watch Monday's video. I distinctly remember we did up those pictures. And I also remember that in the course module lecture, right, we specifically go through what does a bull look like, what does a bear look like, what does a range look like. Okay, what would be a BTC equivalent of USD index? There wouldn't be one. Why would you make that comparison? BTC is a cryptocurrency, a commodity. US dollar index is a fiat currency system that theoretically has no size to it. It's almost like you're asking what would be the gold equivalent to the US dollar index, and there isn't one. Right? This is a commodity that may be priced in this. So that's like asking what would a apple be in comparison to an orange? They're actually totally different asset classes. Remember the first module in our course here. What is a BTC? It is a commodity. What is a USD index? It is a fiat currency system. They're like completely different classes of assets. How should our trade planner look by now? Could you go through an example in detail? Our trade planner. Well, we gave everybody the spreadsheet, so you should be sort of filling out your spreadsheet. I'm not sure if we have that on this. Well, it won't be there. Where is the site? Over here, and we'll go over here, and let's go. One of these things over here, and right here. So, beginning of the course, we showed you this document. You were all supposed to copy it. We had the student one. We even had a couple trade ideas. Basically, your sheet should look like this. And really, you don't know what setups are now, but you can definitely include things like W's in price. You can also now have W's in something like RSI. I don't mind if you want to throw in a fundamental screening tools. And, the irony of this part of the course was that it was actually written for the Canadian Chartered Accountants, their continuing education program. And really, if you can understand the concept of M's and W's, and you can understand the concept of divergence, then you can actually start going and hunting ideas in the marketplace, but you don't really need to be right now. If anything, right now, all I wanted you to do was just simply get comfortable with this thing called the process. And in fact, on the site today, we even had a cute little example, a trade that I did yesterday for real. And I thought it was just a really good example. What the hell is that symbol again? Started with a D, didn't it? D something? D. I can remember what the hell I just bought. It was one of these darn things. Does anybody remember? PDC. There you go. Thank you, Axel. PDC. I knew there was a D in there somewhere. Project Decorum. Yeah, there it is. So here was a perfectly good example of, and you don't even need the trade metric on here, but very good example of a trade that I think all of you, at the very least, could be paper trading. There's nothing wrong with this idea whatsoever. So your spreadsheet would note where the W was, right? Entering there, where your stop is below the W, and where your profit should be. Minimum 2-to-1 risk reward. Just let it work. And you know, as we said just a moment ago, really, this is all I want. You don't really need to know setups right now. That's not really that relevant. What I really want you to be practicing is the process. What day did I enter? What is it I was buying? What price did I pay? What are my reasons? And right now, as I said, even now you can go, well, some clown in the lounge talked about his trade, so I thought, what the hell, I'd ride his coattails. I don't care. You know, are you going to little old lady this less than 5% of your portfolio, even though you guys don't really understand that? I wouldn't even worry about it right now. Do we have any kind of M's and W's that we're working where we're going to just walk away if the W is broken? And based on the, you know, entry, what my risk to is, minimum 2-to-1 risk reward. So what's my target have to be? And then grab a screenshot of it and throw it in the log. That's really all I want. And as we sort of go through the level 1 program in the candy store and you understand what setups are, then you're going to start to get more comfortable with particular ways to actually frame what it is you're doing in the market. Okay, so just to answer that question, maybe somebody write the time of this video right there for your answer. All right. When can we start to book one-on-one with me? That's not involved in this program. Pretty simple. Can you explain again the graph NYSE advanced decline versus Dow you show in the lecture video? All right. I post this in here. Here's the advanced decline line. So you can see advancers versus decliners. I actually like to put on the moving average because if you do the advanced decline line itself, it's just, oh, but Jesus, a lot of information. So I like to put on the moving averages of the advanced decline line. So there they are. And I mean, very simply put, you can use moving averages to hunt for structure. So you can see we have the yellow line is the S&P 500, and this line here, 13 EMA. You could do it as a faster one if you want. But in essence, can you see if we hide the SPY, what letter of the alphabet do we have there in the advanced decline line? Anyone? How are we doing, James? You still with me here, bud? Okay, good. Anybody see a particular letter that just came in here? A W. Very good, Curtis. Excellent. So this is just basically telling us that the breadth of the market is feeling a little better. There are more stocks in the stock market advancing versus declining. Of course, we just had the stock market break there. Can you see stock market breaks? What letter of the alphabet did we have up here? What do these kind of look like? Especially this one right here, right? Up, down, up, boom. What letter of the alphabet does that look like? M. Very good. So hopefully you look at this and go, wow, M's are bearish. The breadth of the market is breaking down. I should probably be thinking that the stock market probably is going to come down. And sure enough, the stock market came down. Now the breadth has cleaned itself up and it's starting to head back up. And gee whiz, what a surprise. The stock market is starting to head back up. Well, earlier you said it's best if it's a perfect shape. Sure. I mean, the more symmetrical these moves are, the better. But does it mean that the market's not going to respect this M? That looks like a pretty symmetrical M to me, Mr. Curtis. That looks like a pretty symmetrical W to me, Mr. Curtis. I'm not quite sure why you don't see that. That looks like a textbook M. That looks like a textbook W. You know, I mean, we can even zoom in. Look at that. It's beautiful. So I'm not quite sure what the point is of that comment. You should be able to see this M. You should be able to see this W. All right, let's keep moving forward. For a W to be considered completed, do we want the price to go above the W middle close, middle high? Does price need to close above, or can we set a stop limit buy, for example, even if it happened to close below? Yeah, so I'm a purist in the marketplace, so to me, all price information is relevant. And I know lots of guys that would trade the stock market and any commodities markets. Keep in mind, I've been trading commodities forever. And if we were looking at, say, W's, look at this little one right here, right? Right, down, right? See that low, up, that high, low, that low. This makes a W. Right, if we drew this, it would go, in fact, here, we should probably do polyline. So we go down, up, down, W. So where does this W confirm? The W confirms right there. Now, we could have this candle finish up here. Candle could finish down here. The fact that the price went through this high on this candle means that the W has fired. Let's see if we can find an example where the M or W is off of a wick or tail. Here's one. So you can see right here, market went up, then came back down, and then went up. And you can see intraday, it fired through here, but it didn't. It actually closed the day here. Lots of traders be more than happy to sell that M right there. Right there. Both perfectly valid. And you can see I got filled. Oh, shitty. Maybe that wasn't such a good trade. Oh, what's going to happen? All right. Oh, cool. I'm feeling good. All right. Feeling good. Woo, right on. Feeling great. All right. So perfectly valid M. No question. Both of those are perfectly valid formations. And really, the question at the end of the day, as we've said repeatedly in this course, is not really like there's a right or wrong way to do this. It's what works for you individually. And what we have to simply understand is that, intraday candles are a little more aggressive. More conservative traders will trade clotheslines. And in this particular case, you can see that if I was trading this clotheslines, we actually have a W there. Sloppy, though, as somebody pointed out, probably not the best symmetrical pattern. I would even say that your clothesline traders would probably be interested in this big W, down, up, down, breakout. And their buy signal would be right there. All right, hope that helps answer that question. Let's put you back to Kendall, because we will be coming back to you later. All right. Okay. If divergence shows and it's not followed by a change in price direction, is it indicative of something else like bull or bear showing weakness? Well, in fact, in the example that we gave to you in the course material, here's an example where the bear divergence didn't necessarily translate into a trade per se. But, in the daily briefs and stuff, we tell people, what should bulls do if they see a bearish divergence? Does anybody know the answer? What should the bulls do if we see a situation where price is making higher highs, but our momentum indicator is not making higher highs? Very good, Axel. Nailed it. All right, we should temper our enthusiasm. Ideally, in trading, we want to have 3 unrelated reasons. So Miguel answered sell, and that is wrong. Why is it wrong? Because we want to have 3 unrelated reasons to consider taking a trade. Indicator confirmation through something like divergence is just one signal. So, as you can see here, this was an example where, yes, there was a bearish divergence, but it didn't really necessarily translate into a trade. Market just kind of went sideways. Long and short of it here is, on the indication of this divergence, if you're a bull, you just got to cool your jets. Well, it's more a question of, and really we'll talk about that, Miguel, later when we get to setups. Really what you should do, and actually we've talked lots about this, Miguel, so go and watch daily briefs. Go and watch the beginning of this course program. Go into the library. What does a setup look like? If you want to jump ahead, but really that's a question for basically the candy store. Well, the specific task for you here was like I showed you with this gentleman's chart. Where was it? Oh, did I put it away? That sucks. Such a nice chart too. I did. Oh, well, I'll scroll back up and find it. I was so impressed with it. We will stop everything for Miguel, and we will show him exactly what it is I want you working on and practicing right now. Nothing about trades right now. Don't even want you thinking about trading hard-earned money. You're still just trying to learn what the heck technical analysis is. Right, so here was that chart. Miguel, you want to work on something right now and impress Brian? This is what I want you practicing. Can I find structure? What happened after the structure? Can I find examples of divergence? What happened after that divergence? That's what I want you working on. Okay, let's keep moving on. In the video, you use the term transition patterns, are those which move action from ranging to trending and vice versa. And you use the term reversal patterns as those which shift trends from bullish to bearish. Well, basically it's the same thing. And vice versa. Do the 7 patterns that we've studied fit both the transition and reversal patterns? Yeah, basically, yep. That's a nice simple answer. I'll just say yes. Done. Okay, in the video, you warn us about avoiding using redundant criteria in our trading plan, like multiple momentum indicators, MACD, RSI, OBV. I understand where you come from, but actually MACD, which derives from price action, and OBV, which derives from volume action, like they hint independent reads and don't overlap as criteria. I'm interested to know your take on why they wouldn't qualify as 2 out of 3 independent criteria in our trading plan. Answer, OBV can be used as 1 reason and MACD can be used for 1 reason for a total of 2 reasons. Yeah, and in fact, we have a setup on the site which we call the DAVO, which is in essence, it looks for volume momentum. And I would personally prefer that you use a fast oscillator like an RSI or a stochastic or a Williams percentage R to use that for momentum. Sometimes the MACD studies moving averages, of course, which we will do later on in the course. And moving average oscillation sometimes is a bit slow. So it's not really the best tool to use in conjunction with a volume momentum indicator. You're right. It's good analysis, a good observation. And if anything, we say we shouldn't couple redundant criteria. Well, this one and this one are basically measuring the same thing. This is measuring something different. So I wouldn't cluster OBV with MACD and RSI. What I probably said in the tutorial is don't do stochastic, MACD, Williams percentage R, and RSI and say that that's 4 readings. Because really, they're all just measuring price momentum. Misreading a MACD is why I'm in this class. Okay, I'm not quite sure where that's going from. And keep in mind, we spend a full week on MACD, and we spend a full week on OBV, so really we don't need to even get into that today. Will you please upload the week 4 slides and notes? Well, that's interesting. I'm not quite sure how to answer that. The week 4 slides should be available right on the page, right? You go here, week 1, there it is there and there. And the Q&A document, you should have this at your discretion. So this should be easily available to you too. So I'm not quite sure how to answer that. The slides are right on the course material. They're right in Thinkific right here. Boom, right there. That's what this and this is. And the Q&A doc, you should be able to access the Q&A doc anywhere. And I've seen James has posted it several times in the lounge today already. So. Brian, I hear your trading plan doesn't consider hidden divergences. According to your experience, are hidden divergences less reliable than regular divergences, or is it just a personal preference? Frankly speaking, I've never met anybody who's actually been able to come up with, when I see this quote unquote hidden divergence, this goes into my setup process. Step 1, I do this. Step 2, I do this. Step 3, I do this. Step 4, I take the trade. So I mean, I've been at this business an awfully long time, and I've never seen. I see lots of kids on Twitter and TradingView going, "Oh, hidden divergence." I've never seen anybody ever actually tell me how they're going to use the hidden divergence in a trade setup. So as a result, I have no respect for hidden divergences whatsoever. None, zero, zilch. Don't mean to be insulting, but that's what I see. And I've been at this game an awfully long time. I do very much respect this concept of confirmed versus potential divergences, helping us in the trade setup process to build edge. So I don't teach hidden divergences. I just don't do it, and I don't even really want to have a conversation. If you want to go out on the internet after you're done this course and learn up on how to use hidden divergences in your trade setups, rock on. And if you want to actually come back and show the community here how you're going to use that hidden divergence to help set up your trade process, rock on, do it. I might even just pay you to write a module, but I've never seen it before, and I've been at this game in a hell of a long time. So that's my direct answer with regard to hidden divergences. Frankly speaking, we don't even need to talk about hidden divergences for the rest of this course. And James, do we ever talk about hidden divergences? Well, maybe James fell asleep. I was hoping he would come on. He's in the class here with me, but I just don't do it. Oh, there he is. He typed it. All right. So I just don't do it. And oh, there he is. What's that?
Never use them.
Now, James has got his high-tech Arkansas internet working. So anyway, thank you very much for chiming in. He did type in the lounge. James and I have been working together for a while, and I don't do it. You can talk about them all you want, Brian, but don't ask me to teach you, because I don't use them, and I've never seen anybody who actually trades effectively with them. All right, let's keep moving on. Please describe the difference between cyclical and secular bull-bear markets. This is a good question. So cyclical has to do with the business cycle, and in essence, right, the business cycle. Have you guys ever seen? I don't know whether it's not really relevant to this course, but later on, for my more advanced students, we get into cycle analysis. And we have, let's see, where do I have that? Yeah. So this is the image that would try and help you understand the difference between secular and cyclical bull and bear markets. So the economic cycle is 10 years in duration, right? And we can show, like recession, growth, the Fed policy of interest rates, blah, 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 blah. Secular would be more this demographic cycle. So, as we, that greed cycle, if you have your Dow chart, we go back and we look at, we got to really zoom out here. So I would say that, is that where you're going to start? Jeez, how irritating. DJI. All right, so I would say that 1980 was the beginning of the last greed cycle. So that's right here. And that ended in 2000. So this is your secular bull market right there. Within this massive secular bull market, there are business cycles. So, 87 crash, there was a recession following that. So this here would be the cyclical bull market. And within this, right, there is ebb and flow. So cyclical, secular. Hopefully that helps you understand that. You could even argue to a certain degree, even though this is heavily manipulated, and we all know because of QE, the printing of money, this is almost a little bit misleading. But nonetheless, secular and cyclical. Hopefully that makes sense. Let's do, so this was Junior Bush, right? And you remember here, this was this is dot-com boom, right? This is the recession that followed the boom. So cyclical bear, cyclical bull, cyclical bear, cyclical bull, right? Secular bull. That makes sense? I hope that makes sense. And then, like I said, this really shouldn't be a bull. The only reason why it is a bull is because they've diluted the shit out of this thing over here. Well, but did you just hear the answer, Miguel? Wow, Miguel fights me tooth and nail here. Did you just hear my answer, Miguel? Why is this moving up, Miguel? What was the answer I gave you? Hello, Miguel. Come in, Miguel. Why is this moving up? Does anybody help Miguel? Why is this moving up? Thanks, Brian. Starting to get it. It's basically long-term versus short-term. Yeah, that's really simple, Oscar, right? Right. And in actual fact, if we go back to budget deficit world, the last secular bear, this should be a secular bear, but the last secular bear actually just went sideways, right? I mean, one could argue the whole reason why you guys are interested in crypto to begin with is because the powers that be did this. This shouldn't happen here. Yeah, that's right, Christopher. This is bullshit, right? That was the whole point of that week 1 module. Okay, intermarket analysis. Do you think formulating a POW index versus POS index chart would be a useful intermarket analysis relationship in crypto? I think it would be. You know, one of our site members, Benjamin, created a really cool index. I think I have it here for you guys. I don't know whether I have it on this screen. No, not this one. But Benjamin created a really cool crypto index. I gotta find the page. Too many windows. My head's gonna explode. Here, this one. And this is sort of the intermarket analysis relationships I like to follow. But he created, the yellow line is his altcoin index, and the teal line is Bitcoin, and the brown, I guess, orange line is Bitcoin and gold. So I really like to follow these. And you could, you know, he just has BitterX alt index. You could go and create this just purely POS coins. That would be really cool. And James is giving you that index link. And if I'm not mistaken, also Benjamin was saying you can create your own indexes. So I think this is a really good conversation. And this is the kind of thing that's going to sort of build out over time. I don't think anybody's actually got a direct answer. I thought it was interesting in today's conversation with our resident bear. Right, we had great conversation about Litecoin versus USD, and you guys probably remember. Well, maybe you do, maybe you don't. But in years gone by, we used to use the Litecoin Bitcoin relationship as a proxy for sort of the health of the altcoin market. Right, as a perfect sort of anti-Bitcoin proxy. So the fact that Litecoin is breaking out here relative to Bitcoin. Does it make sense that this could be an interesting intermarket analysis proxy on the altcoin space? Totally. Faisal? Is that how you pronounce your name? I think that's a great idea. And the cool part about it, guys, is you guys have to understand, you are, you know, to a certain degree, you guys are a lot smarter when it comes to crypto than me. And you're probably going to put some really unique spins. Remember, I showed you guys the resources, your student files, your spreadsheets. I mean, these things are fucking awesome. And the way that you guys do your research, it's so thorough and it's so thick. It's beautiful. So the interesting thing is you're probably going to come up with better stuff than I could probably even create. But I would also say, too, it's really important here to understand that this space is still evolving. And, you know, we went to one site in particular recently, and I thought this was so funny. I don't know whether anybody wants this image, but I'll throw that image in the line there for you just in case if you want it. That's all the different cycles. But one page in particular that we went to, and I was so impressed with it, but geez, it just sort of blows your mind when you look at this stuff. I thought it was in here. Yeah, this one here. You know, you could do your call me Fizz. All right, Fizz. You could do your POW POS screen, and then you come along here and you go, I mean, and I talked to you guys about this before. I mean, look at all these different ways of validating the ledger now. I mean, it's crazy. I never even heard of half of this crap. Right? So you might do your whole analysis. All right, I figured this out. And then they go and change the rules on us again. So just keep that in mind too, eh? I really do like Benjamin's basic altcoin index as a proxy. I really like that. Where is it? Here, this. And, you know, if anything, go and, you know, make different incantations of this altcoin index and see what kind of different, you know, theories and postulations you can come up with different combinations. You might just, you know, reinvent the wheel for all of us. So very good question. Excellent question. Okay, where are we here? I'm having difficulty trying to differentiate oscillation versus momentum. Well, oscillation just is that concept, and really this is a good example, why I have this chart on here. Well, all oscillation is this idea that you can only stretch the rubber band so far. And at some point, the rubber band has got to snap back the other direction. So oscillation, hopefully you can just simply see the market here is oscillated to overbought region, right? Above 70 on the basic default RSI is considered overbought. And conversely, a reading below 30 on these oscillating indicators is a reading that's oversold. And what you should see is that basically the market just oscillates, think rubber band, right? The market just oscillates back and forth between being rubber band being stretched too far to the bull, rubber band being stretched too far to the bear. Oscillation, right? That's all oscillation is. Momentum, on the other hand, is this whole idea of market structure, M's and W's. So if we look at our oscillator that, here clearly has oscillated into the overbought zone, and then, and I don't know whether this is the case here, 88.69, 88.47. So not quite, but we had a better example on the yummies. Right? Can we see that the oscillator has oscillated into the overbought zone? Oscillation, it's overbought. And then momentum is M's and W's. So the momentum of this oscillator here crashed. What direction is momentum? Oh boy, it is down. Oscillation, momentum. Hopefully that helps you understand. Do you see how we had a momentum sell signal here? Momentum buy signal here. You can see M, W. You can see momentum buy signal. Momentum sell signal. Momentum buy signal. Higher highs and higher lows defines a bull market. Lower highs, lower lows defines a bear market. Momentum. Hopefully that helps answer that question. All right, thanks for explaining. Okay, good. All right, in the lounge you said left-hand side MW must be higher than right-hand side. What do you mean by that? Well, actually this is kind of cool. I don't know who typed this out, but in essence, left-hand side of the W, B, is lower than D, the right-hand side of the W. What does that do? I don't know whether I can write a line on here or not. I don't think I can. But if I could draw a line, right, I would just simply draw a nice little up arrow, uptrend. And then B is lower than, or is higher than D. D is lower than B. Connect the dots. It creates a downtrend. So thank you for whoever typed all this out. Way to go. Oh, that sends? Did you grab that? Wait, awesome, James. Okay, next question. When you post links and useful stuff during the lectures, could you post them in here in the Q&A document so we can find them later? Sure, by all means. If I watch the video afterward, it's so hard to find the links in the Rocket chat. It was nice with week 3 when the frame with the useful links was at the top of the Q&A for the week. Very easy to use. Okay, I mean, I'm more than happy to post anything, any place you want. If anything, this is probably where, the people who are writing the document and James as a TA, somebody came in here and dumped send stuff in here. Totally awesome. I see somebody, some Robert J was sitting there. If you happen to see me post an image in the Rocket chat, just go and grab it and fire it right into the homework document. And I can see it on balance We've been doing a lot of that here, so you guys are just kicking ass. Can I, actively keep an eye out for that and try and force myself to dump the links into here too? I can try. I'll try my best. If I happen to miss one, don't get too angry at me, right? Because keep in mind, what I'm trying to do is explain stuff, not try to, make sure that I'm doing the admin correctly. So I hope that answers that question. I suppose, we had this link here talking about the difference between secular and cyclical bull and bear markets. That was right here. Let's see. Is this image? Oh, it is. Look at that. So you guys are already on top of this. Awesome. So hopefully whoever asked this question, you can see that we're trying to help you out here. Okay, when drawing the triangle patterns, do you use the wicks and tails or only candle bodies? It gets messy easily with the wicks and tails. So again, this is not necessarily this is the right way and that's the wrong way. This comes down to personal fit. A lot of people like to use the candle bodies, and what ends up happening when you use candle bodies is it gets rid of a lot of the noise, right? So you notice this wick right here. If I change that to a line chart, no more wick. It's gone. This is going to produce less signals. They're going to be a little more conservative. I think on balance, they might even be a little bit more accurate. If you like to just operate off a line chart, you're going to take less trades. You're going to be a little bit more cautious, a little bit slower. Nothing wrong with that at all. I would highly recommend, though, that you don't get in the habit of switching back and forth to sort of placate your need for validation. That's a dangerous practice to go down. If you like working with clotheslines, stick with clotheslines. If you like working with all of the price action from the candles, stick with the candles. Try not to flip back and forth just to validate your trade thesis. That's a dangerous, dangerous road to fall down. So here, for example, we see, the wicks and tails of these candles creates a very, very wide trading range. And interestingly enough, based off of the wicks and tails, if price actually can move up through this high, what does that produce? Does that produce any particular letter of the alphabet? Obviously, if I ask you that, the odds are that it probably does. Who can tell me? If we work our way up here and break this high, is there any particular letter of the alphabet that will fire on a candle basis? It's a wonderful life. All right. Miguel says W. Very good. All right. Now, if we change this to a line chart, you'll notice that our magical W disappears. Oh, fudge. So if we change this to, remember, if we go up through here on the entire candle pattern, that's a W. But if we change this to a line chart, watch. Hey, where did the W go? In fact, this is a lower low. Brian says that this is not a valid W. You see how this low is lower than that low? It's hard to see, I know, but it is. See that? So it's interesting, more aggressive, the candles themselves, wicks and tails, it would give you a buy signal. But you can see here, there is no W here. Just, it isn't. This is a lower low. And in fact, what actually can often happen here with a market that, if you, and, it's probably important that we just take a moment to talk about this. If you have a market that's actually making, I don't want to do this. Well, I hate when it's all squiggly like that. If you have a market that's making higher lows and higher highs, right? And you're like, well, this looks like a W here, right? Let's say, I don't know, it's like that. And you're like, oh, this is a buy signal. Well, no, that's not true. Why? Because remember, we determine the trend based off of the lows. Where did demand overwhelm supply? So what ends up happening is that's actually your trend. It's still a downtrend. And if we have higher highs like this, then what we actually get is we get an uptrend and a downtrend at the same time. This is what we call a megaphone pattern. And I really want you to avoid this kind of trading pattern like the plague. If you see this kind of price action, just leave it alone. Because I've seen too many people, they will take this buy, this trade idea right here, right? And the market will go up and then, ooh, look how smart I am. And then, and just blast you right out. Very hard to trade. Really advanced traders, they're going to see this breakout here and they're actually going to be hunting for M's right up in this area here to go short. So my advice to all of you, if you see lower lows on the right-hand side, just leave it alone. Don't touch it. Same thing if you see higher highs like that, leave it alone. Don't touch it. This is a megaphone. It's got trouble written all over it. You do not want to trade this kind of M or W. All right. Hopefully that helps answer that question. This is really like personal preference. And like I said, there's not really a right or wrong. It's what works best for you. More conservative, go with clotheslines. More aggressive, use the entire candle. And then, of course, not really relevant to this particular question, but what we really want are nice crisp M's and W's. And if we don't get those crisp M's and W's, with the left-hand side being, for W's being lower than the right-hand side, M's, the left-hand side is higher than the right-hand side, then you could potentially have a megaphone. And that I need all of you guys to just simply write down, do not trade megaphones. They are extremely dangerous. And really, you could even, right here, please refer to Sen's diagram of what M's and W's look like. For reference, there's no megaphones here. These are nice, crisp trend lines. Okay, actually, we got through those questions a lot faster than I was expecting. Let's now maybe head on over. I'll give you some more time if you can think of any more questions. So spend some time. If you can think of any more questions, write them down. Why don't we pop on over to the exam now? And it's just a quiz, not really exam. And let's go through these so everybody has a direct reference. And if you could, on the homework document, because the Monday people were like, you didn't go through the exam. So if you could just write the time on the video, I don't know what the hell the time is, but if you could just write the time on the video so that the Monday people can check out when we went through the exam here. All right, so there's only 11 questions, not too much. No, Joshua, we cannot. Gee whiz, you kill me. I want to talk M's and W's. And M's and Joshua, did you find 10 M's and W's? Did you find heads and shoulders? Did you find triangles? Did you find examples of divergences? That's what I want from you. Okay, question 1. There are how many primary schools of technical analysis? In this course module, I wanted you to understand price analysis. Well, great, Joshua. Awesome. I wanted you to understand indicators as a school of technical analysis. And I wanted you to understand that analyzing one price relative to another price of an asset is a whole school of technical analysis unto itself, what we call intermarket analysis. So the answer I was looking for was 3. Yay. All right. The Dow-Gold ratio is an example of what school of technical analysis? Should be fairly straightforward. Dow-Gold sounds to me like this is a relationship of one asset versus another. And as I said just a moment ago, that is intermarket analysis. And somebody actually emailed and PM'd me earlier saying, that's a typo. So I think it was Tamara, if I'm not mistaken. So congratulations, Tamara. You get a bonus point for catching a typo. Is it geriatrics? No. Price analysis? No. Nomenclature? Well, that's a term for chemistry. Indicator analysis, right? So we had price, indicator, intermarket. I was looking for intermarket. Next question. The two primary market states are, and everybody needs to understand this. This is just very basic 101 technical analysis. We either have a trending market state or a ranging market state. If you do not understand this, this is an image you should print off, staple it to your forehead, and you have to learn this. I mean, you just have to. No choice. So the answer, obviously, I was looking for was two primary states, range and cycle. No. Range and trend. Trend and cycle. No. Cycle and range. No. Cycle and trend. No. Range and trend. Yay. Next question. Markets tend to range, and this is super important. You must know this. 70 to 80% of the time. So professional pit traders, they are going to employ range strategies because they got to be trading every single day of the week. So are they going to rely on a strategy that only is active 20, 30% of the time? Or are they going to trade strategies that are active 70 to 80% of the time? And that goes back to this image. And in the video, I even told you, right? And we have reload zones, right? On a ranging market, traders will simply short against the top end of the range, and they will buy against the bottom end of the range. You've heard me talk about Mountain Man, probably, in the daily briefs and stuff. That's his bread and butter. He is a range trader. So the answer I'm looking for is 70 to 80% of the time the market ranges. Yay. All right, the term used to describe the change in the market from one state to another is called squiggly lines? Nah. Ups and downs? What? Market structure? Floors and ceilings? Well, this should be pretty simple. I wanted to make sure that you look at this and go, duh, right? Market structure is what I'm looking for. The three primary trend change formations taught in this course: M's, W's, heads and shoulders, and triangles. That sounds interesting. M's, W's, triangles, boxes. What the fuck is a box? No, I don't think we talked about that. Heads and shoulders, Y's, triangles. I don't think I've heard reference to Y's. Boxes, Y's, cubes? I don't know what the hell that is. None of the above. Well, M's, W's, heads and shoulders, and triangles. Yay. Okay, indicators measure what two key internal technical gauges? Growth and value? That's a fundamental analysis term. Oscillation and momentum? That sounds interesting. Convergence and divergence? Well, not really. Overbought and oversold? Well, that's an example of oscillation. None of the above. Well, I'm looking for oscillation and momentum. Yay! An indicator is said to be in blank when it is not making new highs, but the price of the asset is moving to new highs. That is divergence. Dun, dun, dun. Yay. Next question. Two stocks that move very closely in price are said to be highly boring. Convergent? Is that even a word? Correlated? That sounds interesting. Curved? None of the above. Well, we're looking for correlated. In essence, that's the definition of correlation. Assets move in conjunction. Next question. Stocks and bonds usually move in opposite directions, which means they must be inversely correlated. I did notice that for some reason the Thinkific platform actually had this B as an answer for the Monday class, and a few people took the quiz and were like, this doesn't make any sense at all. And we went back and we said, yep, you're right. The correct answer is inversely correlated. Next question. Which of the below is an intermarket analysis relationship? Dynamic yield curve? Yes. Futures term structure? Yes. Dow theory? Yes. Market breadth? Yes. Well, if all of these are intermarket analysis relationships, the answer Brian must be looking for is all of the above. Yay! All right, so there's your little mini quiz. Pretty straightforward. I don't think that those questions were too confusing. I thought it was very good that somebody pointed out that intra-market analysis was a typo. And we had this question here. The Thinkific had, for some reason, and maybe it was just a typo on the data entry point, had the wrong answer, and we wanted to make sure that you had that correct. So, okay, so were there any questions in particular with any of these questions? Thanks for all your help, Brian. Very much appreciated. I really enjoyed eating my vegetables. Well, that's good, Oscar. I'm glad you like. Miguel, future term structure was a bit unknown for me. Yeah. That's a very esoteric term. Where should I show you this? I think actually over here. I think I have it over here. If you go to any futures quote board, right, and of course I used to live in the futures market, so. But if we go to any sort of futures quote board, actually that one's not going to work. Let's go this one. Nope, that's not going to work. Let's see if I can find one that's actually going to give us TFC. Here we go. And let's say we pull up the Australian dollar, right? This is the futures term structure. So. And you can look at any asset that has a futures contract. And actually, I'm a bit surprised they don't have Bitcoin on here yet. I suppose at some point they will. But in essence, every single one of these has a term structure. Soybean oil, there's that. Okay. Still eating vegetables or one more week? I've added another question in the document. Okay, good. We have one more week left, and that is in our eating our vegetables, and that is we have to talk a little bit about risk management. So we have to understand the different type of risk takers there are in the world. How professional portfolio managers handle risk. What are the different alternatives that you have? What's a trader to do if they're not in a setup? Trying to figure out what type of risk taker you are, and then determining which risk model you should be following. And then, of course, we're going to explicitly outline that risk model in your trading plan. So yeah, in fact, interestingly enough, out of the, Brian, I don't know whether I showed you guys this or not, but where do I have it? Do I have it in here? I don't know whether this is it or not. Let's see. Yeah. Well, I mean, I have the 2 rules of investing. Here we are here. At least I thought I had the 2 rules in here. Do I not? Well, there 2 rules of investing. I must have done that up here somewhere. Here we are. 2 rules, right? First rule is we want to try and work with setups, predefine what's going to make you act. And then the second rule is all about risk management. And as I told you in this presentation, this is usually where most people just fall asleep and they totally lose interest. And yet I would argue that this is the more important of the 2 rules. If you can manage risk and you can manage your behavior and not fuck up, then you can actually spend a lot of time just simply exploring what does my preferred setup look like. If you cannot handle risk and you can't control yourself, then your days as a trader are going to be very limited. Okay, so somebody said that they had asked another question, so let's see what we got here. Okay, 39, Wicks versus line chart. Is there any danger that a chart using Wick could potentially show MW whilst the line chart shows a megaphone? Yeah, well, I mean, I suppose this S&P chart that we just, or I guess it was the Dow chart. That's exactly what I see happening here, is that you may very easily have a, with this clothesline, right? Technically, that is a megaphone, right? So if the market does go up through here, right, and let's say maybe we rally up there, well, technically that is a clothesline megaphone. Boom. Right? And my advice to you is just leave it alone. Candle-wise, this, first and foremost, and we're going to learn this later on in the course, is this really that great of a trade location to actually be buying up here? That's tough. My hunch is that this wouldn't be that prudent of a trade. And if this does actually come up here and break out, what I would actually expect is the market will come back down and put in a higher close here, somewhere along the lines. And if this really is a bull, then, like I said, we'll break out through the top here. The candle pattern itself confirms. Then you get a pullback. And what we actually like to do, we call it the shark setup, is let's let this bottom come in. Right? Let's just let it do its thing. In a few weeks, we'll talk fibs and use, this fib tool to help us, frame trade location. Maybe this thing pops up like this, right? And what we really want to see is the market pull back into trade location, put in a turn, and then go, right? So maybe you let this double bottom come in, and then on the confirmation of the double bottom, notice there's a nice little price gap right there. You're not going to chase this up here because you look at the line chart and go, gee whiz, this doesn't look like it's bottomed yet. You're going to let the market come back down, test this low, fill in the gap. Then if we do get a close here, then that's going to form this W, and away you go. At the same time too, though, maybe you have your justifications for getting in, pulling the trigger, and your trading plan says, I don't mind if the market has to come down and eat these tails. I'm going to risk to this low. And if this low is busted, it's busted. And I'll just get out. It's no big deal. Really, all that matters is that you're just going to predefine what's going to make you act. And as I had said before, I think, if you do see Megaphone and, you are saying in this case trading clotheslines, you're not even looking at the candles, right? And you see the Megaphone pattern. I think if anything, I would be like, okay, well, let's see if we can get a test of the low and those lows hold, and then we actually have a bottom to work with, and then you're going to go and buy here. Something like that's totally fine. So I hope that helps answer that question. If the yield curve is a great indicator of imminent recession, and it is well known, doesn't that make it less reliable, i.e. the market will start to anticipate the yield? Further, where were the banks taken off guard in 2008? Who says they were taken off guard? I don't recall anybody saying that. I think everybody in the financial services industry knows damn well what's going on here. They all know the game. Keep in mind, the Fed is these banks. These banks are the Fed, and the Fed is the banks. There's no mystery to any of them. And really, I would argue, Jamie Dimon, what's the guy from Goldman Sachs? Feinstein or something like that. Little guy, he's a little bald guy. My hunch is that the Fed actually talks to them before they ever talk to the public. All the bankers know exactly what's going on here. So I don't think the banks were taken off guard. And really what you have to ask yourself is, what's the purpose of sending the curve into inversion? Got to be a reason. And the reason is that the central bankers see that the economy is too hot, inflation is running too hot, and they need to cool things down. And the bankers, they don't want too hot of a market, because that leads to inflation, which, and if it gets out of control, you can have like Brazil hyperinflation, and the whole system's fucked. So one might argue, kind of like 1980, double-digit interest rates. The way that they killed that inflation bull was they just took rates to the moon and brought the economy in line. So first and foremost, don't think banks are caught off guard. And secondly, usually it takes about 6 months for that inversion to actually start being reflected on the balance sheet. And I've seen it happen 2 or 3 times. The curve will invert. All the traders on CNBC and on the floor of the exchange, right, the really smart ones, they'll go inversion, 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 inversion. And since nothing really happens the moment it inverts, the talking heads just go, okay, well, thank you for the information. On to now selling some more Tide laundry detergent. What's going to get more people watching our show? Since the market doesn't break on the inversion event, it often becomes almost buried in the weeds. The only people who actually really follow and track it are the people who actually understand what the fuck's going on and what it implies. All right, I hope that helps answer that question. I'm looking at financial plan picture and trying to realize what's the right mix of assets. Will we be going deeper into that? Move to general later. Really, first and foremost, you have to understand that this course can't really talk to you about financial planning in too great a depth. We're here to teach you how to trade. We're here to teach you how to work off a trading plan. We're here to teach you how to manage your behavior. We're here to teach you how to manage your emotions. I can't really go into this is how you build your financial plan, because really I could have regulators just shit on my head, right? I mean, technically you're supposed to be licensed to be able to be talking about financial planning. I did give you a very basic framework for financial planning, that image off of the site. And the simple rule of thumb, if you want to write this down, whoever's typing, is you just simply want to take your age, subtract that from 100, and that should be your maximum risk exposure. Everything else should be in nice, safe, secure assets, government bonds, T-bills, GICs, term deposits, your primary home, right? Because everybody's got to have a home to live in. So just simply do the math. Don't put all your eggs in one basket. That's just silly. Remember Brian's simple rule of investing. Try not to risk more than 5% of your portfolio in any one single idea. And just simply work with this simple model of your age subtracted from 100 is your maximum risk exposure. And then within that number, start breaking the numbers down. It's just that simple. But to be perfectly honest with you, this is where a lot of people fail in the financial planning process. I don't know if you ever heard the expression penny wise, pound foolish. I think, if you're dealing with anything over, say, $100,000 in assets, it's in your best interest to simply go to a financial planner. It can be easily like a broker, somebody who's licensed, and just simply say, look, this is my situation. What kind of asset mix should I have? And they're going to simply do exactly what I just said with you. You're going to take your age, subtract it from 100, then you're going to start spreading the jelly amongst the various asset classes. And we gave you a nice little framework on the site to help you sort of understand the breakdown of the asset classes and how that respectively works, right? So in here, we've got a model financial plan. So, and this is what it says right here. Age minus 100, maximum percentage of risk assets should be dedicated. And in essence, these are non-risk, cash, government debt, corporate bonds, and really corporate debt, convertible assets, like preferred shares, that kind of stuff. Risk assets, if it's not your primary residence, real estate is considered a commodity investment. Equities, commodities, right? You can see the break. Long and short of it here is, right, just simply follow this plan, try and figure out where your age minus 100 is, and then just start allocating the assets to the individual asset classes. If you've built a plan and you've vetted it out, right, I don't have a problem if you want to PM me and say, Brian, can you just take a look at this plan that I put together for sort of, risk management, asset allocation? Am I heading in a good direction? I'll either give you, yep, looks like you're doing fine, or, oh boy, that's a big problem there. And my advice to you is if you are actually at this stage, don't be penny wise, pound foolish. Spend couple hundred bucks and just go get yourself set up well. And, if you're here in Canada, for example, like brokers work on commission. So get them to work their fucking ass off and just dangle your account in front of their faces and say, if you want my business, I need to have a comprehensive financial plan. And then they'll just basically break down what they think you should do, right? You don't have to take it, but at least they're bidding on your business. I hope that helps answer that question. Okay, I had a question related to rule number 1. I understand you limit downside risk of run by following it. Okay. Drawdown risk of ruin by following it. Not really, right? Drawdown risk of ruin, that's all rule number 2, not rule number 1. Rule number 1 is when we go into the market, we want to be right more than we're wrong. It's simple as that. Try and figure out some sort of, if this happens and that happens and that happens, the odds of me being right versus wrong are greater than 50%. That's what rule number 1 is all about. And I think we can get up into that 60, 70% area. I don't think it's that difficult. But when you look at formulas, they require a payoff variable. But when you look at formulas, they require a payoff variable. Okay. Curious what you considered in there for payoff when you came up with 66% win-loss plus 5% mass risk trade. Doesn't really matter, right? I mean, if you're, the rule in trading is you want to try and I sure hope you guys have taken the time while the library's still up and running and go and listen to people like Andrew Maneker, right? This guy is fucking genius. And he counsels people on managing a lot of assets. I mean, like billions of dollars. Have you actually gone and listened to him? I sure hope so. Anyway, and really, I'm just going to quote him, but this is just a common, should I give you that link there? This is just a common market philosophy. There's the link. You better call him doctor because he does not like to be misreferenced. The rule is we just simply want to try and make sure that our average winner is bigger than our average loser. Does it make sense that if our average winner is bigger than our average loser, and we can be right like 66% of the time, then odds are we're going to be profitable. That's really what this is all about. I would like you in this level 1 program to force yourself to work with that 2-to-1 risk-reward ratio. And as we go through the candy store and you start to understand levels and stuff like that, yeah, they should be, Robert. Yeah. As you go through the candy store and learn levels and tools that we can use to identify how we figure out 2-to-1s, you're going to see that that's a basic industry standard. And a lot of setups that I see in the marketplace already have like sort of 2-to-1 built into them. It's almost like a predetermined, pre-designed trade. It's already set up in advance. So are we really here to reinvent the wheel? Do we have to like, look at it, this works and you can make a lot of money at it, but no, let's not do that. Let's go and do something else. No, I just want you guys to make money from trading. So the very first thing we have to do is we've got to unprogram you. We've got to know, if you're going to risk $1 and your setup fails, you're going to lose that dollar. It's toast. That's just reality. So if I have to make sure that my average winner is bigger than my average loser, then hopefully you understand if I can't see realistically at least making $1 on me being right, I shouldn't even remotely consider the idea. Yes, that question was just answered a moment ago, Fez or Fizz. The key here is if we force ourselves to concentrate on 2-to-1s, that's a great basis to start your education. As traders work with me more and more over time, what ends up happening is some traders like bigger than 2-to-1 risk rewards. Remember I told you about megaphones. Megaphones often produce 5-to-1 risk reward ratios, but they're damn difficult to trade. I don't recommend any of you guys to even consider megaphones at this stage in your education. You're just not ready. So do we have to say at 2-to-1, that's it? That's all the profit I'm going to make? No way, man. Right? There's an old rule in this business. What you really want to do is you want to cut your losers and you want to let your winners run. And that's one reason why this little portfolio is done as well as it is with only $500 invested. Why? Because I don't put a cap on how well we're going to do. As long as the assets just keep doubling in value, great. We'll just sell a little bit more, sell a little bit more, sell a little bit more. But I'm like permanently invested in these things. So please understand, 2-to-1 isn't necessarily written in stone, but it's a very good place for you guys to start to force yourself that when you're right, you get paid more than when you're wrong. Hopefully that helps answer that question. All right, so we're doing here on questions. I see we keep adding. So I find it hard to find triangle bottoms. Could you show on a chart how you find them? Well, really what triangles are. Whoops, here's the phone. Hold on a second. Hi there, still working on class. Can I call you back when I'm done? Okay, talk to you in a bit. All right, bye now. All right, you got to hear me answer a phone halfway through that. What usually happens with quote unquote triangle bottoms, let's see if we can just find one here for you. What they really are, in fact, actually, we could even argue this might be one. Let's see if we can get rid of this stuff. Yes, they're just nothing more than consolidations within consolidations within consolidations. So we could go like this, right? Maybe we'll go down to like, say, an hourly chart. So hopefully you can start to see the triangle forming here. You see? So what should happen inside a triangle is we get multiple reload zones. So do you see how this is a reload zone? Boink. And then the market rallies away from that. And what we should see, proper textbook triangle, actually, we should see this market rally back up into this reload zone. That's sort of what's happening right now, right? See that? And if everything's equal, we should get some sort of rally peak here, right? And it actually should be sort of right around here. Then we draw it off of the lows here, and it should create a reload zone down in here. So like the most perfect textbook triangle formations is just basically a reload zone within a reload zone within a reload zone, and then the thing just launches higher. So this isn't the best one. I just grabbed this off the top of my head, but hopefully you can see that concept of the triangle forming here. And, the most ideal triangle would have seen a nice little dip right into this reload zone, right? Play connect the dots, and then this thing would have taken off here. But it kind of looks to me like this thing's already ready to go. But there's an example of a triangle. Pretty simple. Just FYI, Brian B, as he explained some of the repeat questions. Could be, yeah. Okay, so if I see more triangles over the coming week, I'll post more of them for you. And that was a pretty simple example of a triangle right there. And you could argue, to all intents and purposes, the reload zone and a bullish reversal through here is in essence that testing of the bottom of the triangle, and away we go. But that is an example of one. Okay, no more questions. We're running out of time here, so I think we're going to have to leave it at that. We'll answer these, but basically we're done here for today for new questions. So will you be showing us how to stop loss, say on Bitrex? Bitrex? I don't think Bitrex has stop loss function. Finix has stops. OKCoin has stops. Bitrex, though, does not. I would say if you are, trading M's and W's and you set your alerts on your cell phone, on your computer, and you are going to have to manually stop yourself out on sites like Bitrex. Can you suggest any tutorials? can I suggest tutorials? Well, there is nothing. There is no stop loss function on Bittrex, so I don't think you can do that. My suggestion is you set multiple alerts, and you're going to have to manually exit. Do they have Well, they have conditional sells, but that's on if a profit target is hit, though, right? Not a stop loss level. All right. So, and McGill's suggesting Z Trader and Android. Really, the problem here is there's no industry standardization, right? You even heard the people in the CFTC conference this morning saying we need standardization. As it stands right now, every single exchange operates by its own individual rules. So, yeah, so McGill's saying Z Trader. So you're going to have to familiarize yourself with Z Trader platform if that's what you're going to use. Sites like Coinigy actually let you enter in a whole bunch of stop limit orders, and through their platform, they can trigger. But I'm not going to endorse one site over another. And as I said, really, this is a function of this space has to mature, and we have to create industry standardization. When I was trading, the mature markets, Dow futures, whatever, ES, crude, I used to use a platform called Cunningham T4, and all of my orders were just, where are you going to enter? Where's your stop loss? Where's your profit objective? Hit the order entry button, and everything is taken care of automatically. But that is very specific to the individual platform that you are trading off of. All right, can you explain, so maybe put a time reference to the answer to that question, just so people can go specifically to where we are to hear my thoughts on that. Can you explain what happens when a stop loss is hit? Can you give examples with being long or short, i.e. when you say get out of a trade? Are you selling or converting or buying back in or what? Well, I mean, I'm not that. This to me sounds like you don't even really know what the question is you're asking. If we had, say, the bot, I'll just show you as an example. On the bot here, what am I showing on the screen? Is that the right screen? Oh, yeah, there we go. Here, for example, you would buy the 25 level. Your initial stop would be here at 77, whatever the hell this low is, 77.80. So say 77.79. Give the market, a buck or two below your level. And at this point here, the move stop to break even levels hit. So you'd move your stop to 86.22.64. And on the OKCoin trading platform, it's pretty straightforward. It's not rocket science. When you enter in your order, and again, what you have to understand, every single site's different, but you can see, order history, open orders. They have triggers, trailing, iceberg, open positions. This will show where all your stops are and stuff. And if the market trades up through your stop loss, right, where do they have it? I guess what they'll do is they'll put a margin call level, and if the market goes through that margin call level, then you're stopped out automatically. They'll just take the contract away from you. But unless you're relatively advanced, you level oneers, I don't think you have any business trading on OKCoin. And I would even suggest get your feet wet with sites like Finex 3-to-1 margin kind of idea. Versus trading in the casino, because the casino is the casino, right? This is pretty crazy plays. And really, it's not that difficult. If anything, you're making it bigger than it really is. It's just you're going to enter in your order. You're going to put your stop level. Some of these exchanges, they won't honor the stops. They'll just trip right over your order, And if they don't honor it, well, then you're screwed. So that's why we have to put alerts on our phones and our computers and stuff. And just you have to pull up the actual account when the levels hit, just to make damn sure that your position was closed out. Because remember, this is unregulated. If they can steal your money, they will. Yeah, that's brutal reality in this space. Does an ascending triangle always break out bullishly and a descending triangle bearishly? Or is that just the example you have given? Generally speaking, and if you want to basically, put this in your notes as sort of, what to look for, ascending triangle usually will break out bearishly. So this is backwards. And a descending triangle will usually break out bullishly. So actually, you've got these backwards here. And generally speaking, yep, they're pretty good rules of thumb. Yeah, not bad. In fact, I think we had some descending wedges working on Bitcoin right now, don't we? Seem to remember. I don't have that chart in front of me, just off the top of my head. Over here. Oh, but yeah. I've got that chart somewhere around here. But so I think on balance, those are general rules of thumb, but you just got them backwards. So close. Good job. Okay, I think that's 2 hours. I can feel I'm running out of steam, and I also have to do tutorials later on this afternoon. So I think I'm going to leave it at that for today. We got through all of the questions, so that's good. And we also answered the quiz questions. I think that's good as well. We've got the link for the Wednesday session in here. James doing a great job being TA, and all of you helpers in the class. We're building out one hell of a cool, robust cheat sheet, if you will, for the program. Hey, really, you guys should be set up to kick ass on the final exam here. So, okay, I think we're going to leave it at that. So we will open up the risk management module tonight. Everybody have yourselves an absolute great rest of your day. Be sure to write lots of risk management questions in the homework guide here for next week. And of course, if you still need some help, you can always reach out and just PM me. And the bottom line here, guys, is you have to absolutely practice. So get in the lounge, post charts, ask whether you're doing it correctly. Is this a valid M or W or triangle or head and shoulders? Is this a valid divergence? Stick with just RSI right now. You don't need to be doing any fancy indicators right now. And like I showed you, that one gentleman, Keith, who did that chart up earlier today, that I was so impressed with. This is what I want you to have for your notebook going forward in life. Okay, you all have yourselves a great rest of your day. All the best, and bye for